Welcome to the Commodities Institute podcast. I'm your host, Emily Costa. It is Wednesday, January 21st, 2026, and we have a packed episode today covering significant shifts across the global resource landscape, from major corporate mergers in the mining sector to a historic return to nuclear power in Japan. The stories we are tracking today underscore a world in deep transition. We begin today with some massive news in the metals sector. Rio Tinto has reported a very strong fourth quarter, beating expectations for both iron ore and copper production. This is a significant win for their newly appointed chief executive, Simon Trott, and it looks like Rio is well positioned to maintain its title as the top producer of iron ore globally. But the real story here is the ongoing merger talks with Glencore. If this deal goes through, it would create the largest mining company in the world. Analysts are keeping a close eye on this because, under United Kingdom takeover rules, Rio Tinto has until February 5th to make a formal offer. This merger would essentially combine Rio's operational expertise with Glencore's vast portfolio, particularly in copper, which is seeing soaring demand due to the rise of artificial intelligence and the energy transition. Staying in the metals world, there is an exclusive story coming out of the Democratic Republic of Congo. The Congolese government has sent a shortlist of state-owned mineral assets to Washington for United States investors to consider. This includes projects for manganese, copper, cobalt, gold, and lithium. This is a huge geopolitical move. For years, China has dominated the refining and export of these strategic minerals, but the United States is racing to reduce that reliance. This new minerals partnership, which was helped along by diplomatic efforts to ease regional tensions, represents the most tangible progress we have seen yet in securing a Western-led supply chain for the critical metals needed for modern technology. Now, let us shift our focus to carbon and power, where we are seeing two major developments. First, analysts are forecasting that global liquefied natural gas output is set to jump significantly this year. We are looking at least 35 million metric tons of new capacity coming online, primarily from the United States and Qatar. This is expected to be a transitional year where the market moves from tightness toward ample availability. For consumers in places like China, India, and Europe, this could mean lower prices, with spot prices in Asia potentially falling below $10 per million British thermal units. This supply wave is expected to last until 2029, which could fundamentally change how emerging economies source their energy. Meanwhile, in Japan, we are witnessing a historic moment for the energy industry. Tokyo Electric Power, or TEPCO, is scheduled to restart a reactor at the Kashiwazaki Kariwa nuclear power plant today. This is the first time TEPCO has put a reactor back online since the Fukushima disaster in 2011. The reactor in question, unit number 6, is a 1.36 gigawatt facility. This restart is a major test for the entire Japanese nuclear industry. Prime Minister Sanae Takaichi is pushing hard for a nuclear comeback to boost energy security and reduce the country's dependence on expensive fossil fuel imports. If this unit reaches full commercial operation by the end of February, it could significantly reduce Japan's need for liquefied natural gas imports this year. Moving into the agricultural sector, the news is a bit more troubling, specifically in Ghana. Cocoa farmers there are facing a severe payment crisis. A new system was introduced for the 2024-2025 season that shifted the burden of financing purchases from the state regulator to international traders. However, because global cocoa prices have dropped by about 20% this year, those traders are refusing to pay the upfront deposits the state requires. This has left the world's second largest producer with a massive stockpile of beans and farmers who have not been paid since November. This is a dangerous situation because without payment, farmers cannot afford essential maintenance like pruning and applying fertilizer, which puts the next harvest at serious risk. In Europe, farmers are also watching the weather with concern. In Ukraine, a combination of deep frosts reaching minus 18 degrees Celsius and prolonged freezing rain has created a thick ice crust over winter wheat and rapeseed crops. The Ukrainian Agrarian Council warns that if this ice layer persists for several weeks, it could cause significant damage to the harvest. We will have a clearer picture of the impact in about 2 weeks, but for now the risks to these high-yield winter grains are quite high. In the oil markets, the spotlight is on Kazakhstan. The massive Tengiz oil field, which is one of the largest in the world, has been forced to shut down production. This follows a fire at a power station over the weekend. Sources say the field could remain closed for another 7 to 10 days, and some suggest the disruption could even last into February. This has already led to the cancellation of 5 export cargoes of crude oil. However, it is not all bad news for Kazakh production. Interestingly, other major fields like Kashagan and Karachaganak have ramped up their output rapidly to compensate for the shutdown. In fact, production at Kashagan rose by 28% in the middle of January compared to the start of the month. So while the Tengiz outage is significant, the overall impact on Kazakhstan's total output has been partially mitigated by these other producers. Finally, we take a look at dry freight and trade volumes in the European Union. Data through mid-January shows that soft wheat exports are down about 2% compared to last year, totaling nearly 12 million metric tons. France and Romania remain the heavy hitters in this space. On the import side, there has been a notable drop in oilseeds. Soybean imports are down 16%, and rapeseed imports have plummeted by 41% compared to the same period last year. While some of this data is currently incomplete due to technical issues at the European Commission, the trend suggests a softening in demand for these specific commodities within the bloc. It is clear that the theme for early 2026 is one of reconfiguration. Whether it is shifting mineral alliances in Africa, a massive wave of new gas supply, or the difficult restructuring of agricultural finance in West Africa, the commodities world is moving at a breakneck pace. We will continue to track these developments as they unfold. That wraps up today's episode of the Commodities Institute podcast. Thank you for joining me for this deep dive into the markets. If you found this episode valuable, be sure to subscribe, share, and leave a review.